We'll discuss markets with Dhiraj Sachdev of Roha Ventures, who joins in to discuss the market fundamentals, more importantly, his top sectoral picks as well. Dhiraj, the street believes that consumption is likely to recover given the sort of steps that the government has taken, etc. I just wanted to know how much of that is in the price already. And secondly, with the rupee weakening, do you see that as a risk, a further risk of FII outflow over and above what we've seen already?
Yeah, hi, good morning. So specifically on the consumption side, I think we are seeing a host of segments within the consumption basket, and not all of them are equally valued. I mean, there are certain segments of the consumption basket which are overvalued, while some offer opportunities. I mean, we are positive structurally because given the underpenetration or better credit or improving credit cycle, lower interest rates or better monsoons, and of course the policy initiatives like tax or interest rates or GST cuts. Now, there is a clear shift from unorganized to organized players across many segments of the consumption basket, which includes digital media or jewelry segment or value fashion segment, or even organized retail players within the alcohol beverages, etc. So in consumption basket, we are avoiding durables that are expensive on valuations and an FMCG segment which are facing D2C competition, particularly of late because of the online channels and has slower growth rates. So this is where the space is divided in the consumption basket. On the FII flow, I think we don't believe that the FII outflows, which has been over the last few months, is going to be the case going forward. In case rupee has already depreciated about 4-5%, it's quite possible that FIIs would like to come in maybe early part of next year or the whole of next year, and not only gain on the currency front, but also on the equity, given the valuations in some cases has corrected over the last few months. So we don't believe that FII outflows will have pressure because of the rupee.
Dhiraj, I was just reading your note where one of your points mentioned that there are some contra opportunities that are emerging in some of the good quality companies which are currently lacking growth. Or a temporary cycle at that. Does EMS fall into that, or do you still believe that even after the kind of correction that these companies have seen, they still fall on the expensive side?
No. Certainly EMS is not a contra opportunity. EMS is a well-discovered thing over the last couple of years, and the valuations have gone ahead of time. And the earnings are yet to catch up, and they're still expensive. So I think one has to take a longer term call on this business. While it is very structural, India's manufacturing cycle has started, and EMS companies will gain over the longer period of time. But valuations are so demanding, and I don't think it offers margin of safety. What we said on the contra opportunities is that there are quality players where they are passing through temporary growth issues. And because of that, the market has hammered them quarter after quarter over the last few or maybe last couple of quarters. And this may include some companies in the specialty chemical segment or a fewer manufacturing or capital goods companies where capex is done and the earnings growth will play out over the next 2 or 3 years. And that is where the contra opportunities we are talking about.
Good morning. Hi, this is Ritu. You're also a core overweight for you is also banks and NBFCs. There, of course, with the spate of rate cuts, a bit of margin pressure in the near term, but the larger, environment of regulatory easing we've been seeing from RBI, where do you see sustainable growth opportunities without a compromise on asset quality? And, the second sector is auto and the CV cycle, where you believe the up cycle is just about starting. Just give us your broad view on why you think the sector has legs and, some of the interesting names that excite you.
Yeah, so good morning, Ritu. See, I think India is clearly we all know that it's a capital-starved economy, and banking and financial services industries have become growth businesses. In a capital-starved economy, there are a lot of companies in the NBFC or banks who are offering specialized financing. So whether it is home financing or commercial vehicle financing or gold financing or even SME financing. And that is going to see a sustained credit growth over a period of time. So they are growth businesses as a sector as such. Only thing is that we have to be obviously cognizant there are a number of NBFC players and there are a number of banks. And those in the mortgage lending business ideally should be preferred, or those who have better strict risk control norms in place. So we have a plethora of opportunities for banks and NBFCs. And in this market, which has been slightly on the higher side in terms of valuations, banks and NBFCs do offer opportunities. In
All right.
auto, what we are seeing is, again, there are a number of players and it's again a heterogeneous sector, but we are beginning to see a CV cycle on the uptrend. And this upcycle will help a lot of ancillaries which are exposed to CVs, whether it is tires or forging companies or axle companies, including the OEM companies themselves in the CV space. And also there could be better replacement demand that can come from new emission norms in CV, besides the EV transition that is happening even within the MHCV, LCV spaces. So I think auto ancillary and auto.
All right, we take that point. Unfortunately, lost that feed. But just, before we go across to Manisha,